Inflation surprise. Are rate cut hopes smashed? Does it mean it's all over? Or are we being led by the popular press? If we look at the Times here, inflation was pushed higher by a clutch of household bills, including energy, water and broadband, rising sharply in what analysts, we know not what analysts these are, awful April. That's what the Times said. But is it true? So let's look at the underlying factors, drivers of inflation. UK headline inflation rose 3.5% in April, up from 2.6% in March, a 15-month high and above the forecasts of 3.3% as was expected. What are the main contributors? Water bills, and I know it's getting into the summer, so everyone starts having a bath every day. So water bills are up 26.1%. Energy bills, because of that, because we heat the water for us all to have baths, have gone up by as much. And the April's price cap reset was upwards when energy bill prices actually come down. So that's a bit of a strange one, an oxymoron. Road tax hikes and airfare surges over the Easter period. Apparently it's like zoned pricing. A lot of airfares went up over Easter, way above what they would normally do so. So it's a bit of an unnormal scenario. Services inflation, which B of E does watch very closely, rose by 5.4% against 4.7% in March. And core inflation, that excluding energy and food, rose by 3.8%. Again, above expectations. So what's the impact? What's the outlook for that? What do the pundits think? Well, according to the FT and the Times, Hugh Pill of the Bank of England chief economist, great name, Hugh Pill, warned that inflation's decline is stuttering. There are internal divisions on the MPC, the Monetary Policy Committee, with some members concerned the bank is cutting too quickly. Some want to cut less, which includes the chief of the Bank of England, Mr. Bailey, and then some think it should just hold as they are. So there's quite a few divisions within the 5 people on the Monetary Policy Committee. Markets are now pricing just one more base rate cut before the end of the year, rather than 2 that was expected, i.e. in June and then in November. Economists, though, are not. So that's the point. The economists are looking at the underlying fundamentals and saying that is not the case. An example being the financial institution ING Bank, is still pricing in 2 cuts. James Smith from the UK Development Markets, who's the UK Developed Markets economist at ING, said inflation should fall back this summer, keeping the Bank of England on track for its quarterly rate cuts throughout this year and into 2026. The same with economists at Deutsche Bank. They're even more dovish, saying they'll have 3 cuts by the end of the year. These are what the economists, the big brains, are saying. Reacting to news of the higher than anticipated inflation, Sanjay Raja, who's the chief UK economist at the bank, said this is not the end of the quarterly cutting cycle, not yet at least. While the bar may be higher than the August rate cut than previously thought, it's likely the majority of the MPC will look past this if inflation expectations start to recede, as we expect them to ahead of the August decision. While a cut in August seems likely in our view, it has certainly become a lot more likely and more possible to happen. It's all about the MPC. Any talk of a dovish pivot from Q2 2025 should be put to rest. We expect it to continue to be cut. In other words, don't expect a rate cut in June. It'll possibly happen, not definitely, but certainly at least 1 more, if not 2 by end of year.
Sorry to interrupt, but if you're enjoying this piece of content and would like to find out more about buying property and our key 10 steps to doing so, then pop your details in the link below somewhere and grab a copy of our book, 10 Steps to 10K, the Expat Property Playbook. Enjoy.
What were the market and currency reactions? The pound briefly jumped to 134.7 against the dollar, its highest since 2022, before coming off again. 2-year gilts, which are sensitive to rate expectations, climbed to 4.008%. This signals that markets are now potentially positioning for a higher for longer interest rate situation. Political fallout, public response, well, naturally, of course, Rachel Reeves said the figures are disappointing, but a lot less than it was when the previous lot were in power. All this silly backbiting. Opposition criticised Labour's tax rises, including national insurance and minimum wage increases. They fueled the price pressures. UK inflation, though, looking at it from an outside-in perspective, is higher than any other country, any other Western economy, except Netherlands. So looking forward, what do we think? What do we think the Bank of England will do? Inflation is a temporary thing, this current one. It slows 2.6% in March. It's jumped back up to 3.5% in April. It's largely driven by a number of isolated factors over Easter, such as airfares and water. They're not directly linked to the underlying cost pressures in the UK economy. Meanwhile, other service prices that are more closely linked to activity and cost pressures are likely on course to pull down inflation in the coming months. That's a direct quote from Andrew Bailey, who is the head of the MPC. The bank also said Trump's tariffs are more likely to be deflationary rather than inflationary in the UK, with trade restrictions acting as a drag on economic activity. However, a significant amount of or degree of uncertainty remains, both in terms of trade and other variables. I mean, there's heaps of things out there. This year has turned into last year included, a very volatile couple of years, with the Ukrainian conflict, with, before that with COVID. It's a world we've not lived in for a long time. We need to watch very carefully, Mr. Bailey said, for any signs of near-term increased inflation that could lead to additional second-round effects on wage and price setting, even if that is not our normal assumption, but also for any further weakening in demand, which would reduce inflationary pressure. For now, he said, we are seeing signs of cooling in the labour market. The latest report published on 13th of May showed annual wage growth slowed to 5.6% between January and March versus the previous 3-month period. This is lower than the 5.9% reading in the previous report. The unemployment rate picked up to 4.5% of the same period, up from 4.4%. Both of these metrics are watched very closely with the Bank of England, but it's too soon to really work out whether or not this really is a long-term trend. And frankly, the economists are saying no. The bank is saying, well, we don't know. They have to sit on the fence because they make mistakes like they did with quantitative easing. They get a lot of criticism for that. So what does it actually mean to us as international or property investors? Rate cuts are on pause, perhaps not a cut in June, but they will continue. Mortgage rates are likely to remain elevated in the short term with limited relief for buyers and refinancers. So therefore, not smashed at all, just paused. Some comments and questions from our readers over the last month or so. Matt Evans, lovely gentleman. I could talk about him all day long. He says, good stuff as usual. Shanif Smart said, I don't think the picture is as good as that for landlords. Things have worsened considerably. Yes, when you're at the coalface and you're looking at it, say if you've got a flat in Eastbourne that you're renting out on a buy-to-let basis and you can't get tenants in because of post-COVID run away from the coasts because of the fact that a lot of immigrants have moved in down there. Not that there's anything wrong with immigrants. It just happens to be that those sort of places are attracting a lot. They've got a lot of guest houses that the government's spending its $26 billion a year putting immigrants into. So for those sorts of people, it is quite bad. Having said that, we just finished a development in the centre of Chesterfield and it was fully tenanted within 2 weeks. So for some areas, it's not so great. For others, it's still business as usual. The unknown H said, could you please advise? I've renewed my AST with my tenant. If I want to sell next year, what would be the best approach to end the contract with my tenant? Well, it's a short-term rental. Surely then you have a short-term contract. So it should be easy enough just to terminate it whenever it finishes. If it's a long-term contract, then if you are going to sell it, then my approach would be, I'm selling it, I'm moving in to do it up. Because I'm moving in, I need you to move out. Apologies for that, but that's the way it is. That's a simple way around it. Okay, that's market wrap for this week. We're almost out of hard copies of this because it is flown off the shelves. Log on and get a copy if you wish. Do go to our new property portfolio channel where we're posting how to build portfolios. We've got a number of podcasts up there, most recently ones we've done with Knight Frank and Savills, big hitters. But go on there if you can and have a look. Thank you very much for listening. Do take care. Stuart Williamson.